Okay, we're at 12:31. Hopefully everyone can see the shared screen. See our starting screen. Okay, I think it's time to kick off. So hello everyone, and welcome to Foulger Underwood's latest accounting, M&A and market update. My name's Kevin Reed, and over the next 40 to 45 minutes or so, I'll be asking questions of Foulger Underwood MD, Keith Underwood. Keith, give us a wave.
Good afternoon, everyone.
So today's session will revolve around the M&A market for the accountancy sector in the UK, and the topics for our session are on the screen in front of you. We'll be covering updates on both the smaller and larger practice markets. We'll have some discussion on specialist service line practices, and there's going to be quite a bit of detail about what the consolidators are up to. So I'll end my share screen just for the time being. And I'll just go through some quick housekeeping before Keith kicks off proper. For those of you who don't know us, Foulger Underwood is a leading advisor to professional services firms, helping them with M&A advice through to succession planning, strategy, and leadership development, among other things. And visit foulgerunderwood.com to find out more. I guess it's important for you guys to know that we are happy to take questions. Feel free to use the Q&A button to send them in, and we will broach them either as they arrive, if they fit the flow of conversation, or we'll keep them to the end of the session. We've already had a few questions in, so thank you very much. And we're going to cover those as we go along. If you have questions that you deem sensitive, or you just like to have a chat and a catch up, then feel free to drop Keith a line at keith@foulgerunderwood.com. And if you're watching a recording of this, then drop a comment in YouTube or email Keith. And today's session, as I said, is up to about 45 minutes. So I'm just going to share our screen again, which you should be able to see. And move on to our first slide proper. Keith, it's over to you.
Yes, good afternoon, everybody. The agenda for this meeting is focused initially on smaller practices. We had a few feedbacks last time in February that perhaps we concentrated more on the consolidators and larger firm situations than we did on smaller firms. And I know a number of you are indeed smaller firms looking at the marketplace and wondering where it will go or how you might wish to consider your succession coming through in the future. So the first slides really deal with the smaller market practice market. It is still very active. Hasn't changed a great deal in multiples being offered. We're seeing deals go through at that 90p to 120 level. Exceptionally, where there are exceptional profitability, we do have seen one or two at 1.4 times. But then usually that's based on super profits being exceptional profits, or being a specialized area, which we'll talk about later on, in terms of a specialist that the purchaser requires to fulfill his range of service offerings.
Keith, it does seem that interesting that that you can have these exceptional value deals. Are there one or two things you could flag up as to why you get such a difference?
Well, it is based on, as I said, specializations and a need in the market for those specializations, or a perceived need in the market from larger firms for those specializations, or indeed clearly on profitability. And we've sold somebody in the last 2 years who was doing about 750,000, but his profitability was about 400,000. He had it nicely streamed, very well run, and his, if I could say, his clients were very well trained in terms of delivering data, and he was extremely profitable. So that went at a higher end of those multiples, but that was an exception, and we don't often come across practices of that nature.
Okay, thank you.
So I think the drawback to the smaller practices are location and size. And to a certain extent, location is key. There are certain areas of the country, as we cover nationally, and indeed Ireland. You didn't mention Ireland, you mentioned United Kingdom, actually, Kevin. But we have got a few people from Ireland on board as well, which is also an area where we specialize. So in these terms, location can sometimes be a drawback because you don't have the audience who are interested in that location, or they don't have an office in that location where they can subsume smaller practices. I mean, see, for instance, we've got two on the South Coast at the moment, around 600,000, actually one's 500,000, one's 600,000, which are not moving very quickly. So any of you interested in acquisition on the South Coast, let me know. It's a bit of advertising, but we don't normally do that. So looking further down, on pricing in this area, we are looking at multiples of fees up to, say, $1 million. If you're going between the $1 million of fees and 3 million, you're starting to revert to EBITDA, multiple partners, most likely a couple of partners ongoing and one exiting. So you are looking at EBITDA coming in perhaps exceptionally in the 1 million to 3 million levels. And of course, 3 million, it's prevalent to above 3 million to work on an EBITDA rather than a multiple of fees.
Can I ask on behalf of our audience why that is the case, Keith?
I think it's just difficult to get an EBITDA out, a sensible EBITDA out of a sole practitioner practice where they're perhaps lifestyle driven and or doing an exceptional amount of work on the business, on the clients, rather than managing the business and the direction and strategy of the business. So I think in those situations, it's very difficult and it still reverts back to a multiple of fees. So I think the buyers in this section as well, interestingly enough, are primarily other LLPs, smaller practices, looking for growth. Very few consolidators, which is a point we make later on. But there are some smaller consolidators operating in the sector, which I'll refer to. But mainly it's LLPs and independents who are the buyers here. And as you can see from the multiples, not dramatically changed since the consolidators entered the market. So it hasn't sort of pulled prices up exceptionally. So the market's quite polarized into the people we find in this sector of 1 to 3 million. The retirement of traditional fees, 500K to $1 million, say, is still prevalent where the sole practitioner or founder is wishing to exit and wishing to pass on his fees and staff and look for a good home. The problems with these sort of fees, have to be very careful looking at them, is that there's quite often a large time involvement for the purchaser in onboarding these fees, and sometimes the businesses have not been run commercially and are therefore sub-profitability levels. The key thing, though, is the quality of the fees and how the larger firm looks at this portfolio and the value it places on it once it's onboarded into their own structure and operations. Digitalized practices, we're seeing an increase here, and we've mentioned this before in previous market updates. These are the ones at the second stage of growth. There is a flow of these now where people have grown to a certain level, still younger entrepreneurial professionals who are looking to then pass on their business to larger firms or indeed to similar digitalized practices.
Keith, would a digitized practice have therefore digital savvy clients and therefore just overall that you'd expect good processes to be in place, and therefore does that make them a more straightforward sale?
To an extent, although with a larger practice, of course, the larger practice would normally be a more general practice and possibly wouldn't be able to absorb it and maximize the outcomes unless they're digitalized themselves. But you're absolutely right. The features of these businesses are usually we've got clients paying on a subscription basis every month. They're usually they're very good at onboarding information through Xero or one of the uplift systems on their own account rather than delivering data in a spreadsheet format or less than even a spreadsheet. So yes, they're a certain type of business, and they usually have higher margins due to the fact that they don't have the bookkeeping.
Quite a sensitive question. Can we ask though, if you're dealing with if you're looking to acquire or from from an entrepreneur, as you describe it, does that create any complexity in the deal, shall we say?
It's a complexity in that these people are usually interested in their mid to late 30s of getting out, taking their money, and then investing it elsewhere. And a lot of them have got clear ideas of where they're going to take this. Sometimes it's into a software business, sometimes it's into something totally different. But they've built it up to a certain level. They're not necessarily team players in a larger organization, so won't necessarily integrate with the larger firm as a part of their management team, but are looking for an out, handing over the clients, possibly selling the software. I mean, there's a point here on software. They usually developed a good software group application pack, but sometimes it's not no value to the acquirer who's looking for the fee portfolios to be put across their own software and uplifted onto their own software. So it then turns into a portfolio sale, and you lose a bit of the premium you might expect from a digitalized practice. So I think the other going on from that, I think we've also got situations for merger sales of 3 to 4 partners. And I think you've got a question on this later on, Kevin. A lot of businesses are still in that section of having a couple of retirements, or one retirement, and then 2 partners ongoing. And this is typical of a £3 million and practice. Retiring and ongoing partners need different deal structures. They have to be sold differently, and you're basically negotiating 2 deals with the acquirer to satisfy the objectives of these 2 groups of partners. There's a lot of that.
So it's more complex, but effectively you're running concurrent deals, aren't you?
You're running concurrent deals, and you need to backfill, if you like, the experience of the exiting partner. You need to make sure the younger partner has got aspirations and can actually move forward with the acquiring practice and satisfy his needs if he wants to become an equity partner, or indeed if he wants to sell out and become a salaried partner. So many different aspects of those sort of deals. I suppose the additional one is we've got 2 or 3 MBOs going on where there are a group of managers and or younger partners who wish to take over from the equity partners, and we consult on those sort of situations to ensure that they're successful deals through to completion. I think the 3 fee levels that we're looking at on this, up to 3 million, are not generally of interest to the consolidators. Although we do have a couple of consolidators in the Midlands and one in the Southeast England who are doing deals at the 2 million level, but the mantra still seems to be for the larger consolidators, 4 million in fees, 1 million EBITDA, and then they'll have a look at it. But some of them are building smaller roll-ups, so we don't dismiss that. And we've got 3 or 4 deals going through at the moment with consolidators at different stages for practices under 3 million. But of course, one has to look very carefully at the deals and where that's going for the future. We'll talk about consolidators later on.
So
I think the other.
Are you ready to move on to the next slide, Keith?
One more on this slide. I think one additional point which we see coming through on a few calls recently is the question whether there'll be a surge of founding members trying to get out of smaller practices due to tax changes which might come through in the next 6 months. Capital gains tax changes, of course. We've always had these situations, and of course you have to wait until the legislation comes through. But I can see surges previously, I think it was in 2016 and earlier than that, when there was some indication that capital gains tax would change. So we are looking possibly at a bit of a flurry and surge to get some sales through before the tax changes come into effect. So we might see an uplift over the next few months, 6 months, as people are trying to head off the additional tax charge which is likely to come through.
Okay.
Yes.
Before we hit the next slide button, Keith, so just one other question that we'd had through. I think you've kind of answered it, but if you want to add anything more, then obviously feel free to. So someone said, I've got €1 million practice. Is there appetite in the market for this type of practice, and how would an acquisition of this size practice work? So who's buying €1 million practices? If €1 million, I'm assuming an Irish practice.
Yeah, it'd be an Irish practice looking at the participants today, although we've got a couple out of Europe. Yes, there's no problem with that sort of size practice. It depends on how many partners you have, and obviously we can talk about that in detail as to who would be interested in it. But obviously the Irish market in particular is very active. There are some of the consolidators involved, and there are some LLPs out there doing deals in the Irish market, which of course is an exact replica, but significantly smaller market than the UK marketplace. So there have been a number of deals out there already, but there are still many more to be made for the right practice. So we'd need to know a little more about the practice, target practice, to be able to comment on that a bit any further.
Very good. No, that's fair enough. But I think the short answer to that is the market's active. There we go.
Yeah, absolutely.
Okay, so we move on to the next slide.
Yes, please. So on above 3 million, there is still consolidation going on. And I think just to mention a few at the moment, the LLPs are active. And when I refer to LLPs, they are the non-consolidators, the non-PE moneyed funds which are going around making acquisitions. So you've got LLP deals in the last 3 months. You've got MHA taking over Moore and Smalley, which is a fairly big deal in the Northwest. You've got Crowe taking over a couple of small practices, recently announced. Armstrong Watson in the marketplace for smaller practices, again of a specialist and low geographic area. So that part of the market is still going very well. Menzies have just announced in the last couple of days the taking on of a recovery business. So they're still out there doing the consolidations. On the consolidator side, rather than just consolidations generally, in the last 3 months, Summer seems to have completed their 9 or 10 acquisitions to create their hubs regionally. That's come through. Assets have taken over a specialist area in the RSM business. They took over medical fees out of RSM. Danes have entered Scotland, another consolidator. And interestingly, Moores Kingston Smith took over WMT, which is an M25 practice in the heartland of Kingston Smith, of course. But that's another active consolidator at the moment. And there are many. We've got a list of about 20 other deals that have gone through with the consolidators and LLPs, but that's just a flavor to indicate that the recent announcements, there's a continuing trend, there's a continuing pipeline for these parties, although the opportunities are becoming more limited. So on the second point here, the focus seems to be scaling these mid-sized OMBs and SME businesses and providing advisory services. And I suppose the two deals here which come to mind are Danes, who took over a specialist VAT business, acquiring specialist services which they can then cross-sell across the rest of their portfolio, and Assets looking to go into the medical, a specialist in the medical sector, with their acquisition of RSM, which was not only the partnership level and manager level, but also the medical section entirely for the portfolio of medical fees that RSM have picked up. So that activity is continuing. Quality of clients and advisory, leading to advisory, important for both the LLPs and the consolidators. And there is a bit of a question mark over smaller fees and how they can be onboarded, how they can be rationalized for the future, and the time it takes to onboard some of those smaller fees, which is becoming as I say, a constant issue when we look at managing acquisitions and looking at the aspirations of the acquirers. I think with that, the consolidators going on, there are increasingly asked questions about client loyalty and partner client commitment, we'll have a little more on this later on with some of the developments on the consolidator side, but it applies to the ALPs, it applies to small practices as well. And the client loyalty, which has always been very sound in the accounting practice, in most practices, is built on the partner relationship. And there are people asking questions now whether that is now being broken down with more consolidator activity, and particularly with some of the consolidator rationalization that's going on.
Just so you know, Keith, we're running at 21 minutes, so we're about
Yeah,
halfway through our session.
that's fine. Carry on. Next slide. So I thought I'd spend a couple of minutes on what we've seen coming across our desks as well on specialized businesses, because it applies to smaller practices, some of whom are very sound. We've got e-commerce specialist and media specialist businesses in the smaller section, but also the larger firms now looking at specialization, streaming their business, trying to get service lines rationalized nationally across a range of offices which previously have run fairly autonomously. And the areas we've been looking at, and certainly we've seen in the last 3 to 6 months, are covered here. Charity audits seem to become more specialist services. We've had 2 businesses with FCO services. That's financial, what we call financial controller operations. Are dedicated to that, won't pick up audit, won't do other advisory work, but actually just providing the outsourced accounting and then going back in and providing FCO or FD services to those particular clients. So we just put that up there as an idea of some of the specializations coming in. And we're also valuing businesses where they have exceptional concentrations of perhaps 1 or 2 of these areas, specialist areas, on a different basis to the general practices. And that would
Keith, I mean, you would normally have a broad general practice that would find fits into various specialist service lines, either by the quality and expertise of the people within them, and or I guess from a regional basis, the type of clients that are actually close to them, you know, whether you're like farming and agricultural, for example. Is there a step change that's gone on? Are small and burgeoning practices looking to niche more quickly or earlier in their life cycle?
No, absolutely. And some of them are starting up, specializing in these areas. I mean, so we've had a couple of e-commerce businesses which are purely e-commerce clients. They do not go out and take anybody else on. They're a specialist in that area and have therefore come up with, you know, one of them was approaching $1 million in fees, very much in the e-commerce section. They have a specialization in VAT and things like this, which support that e-commerce trade. But it is interesting that these are startups specialized in these areas, maybe not agriculture, but certainly we've seen some specialists in FCO services, hospitality, and media, which I think is a trend for the future.
So I'll just jump in again, Keith. We did have a question a little bit earlier. I apologize for missing it, but it may be something that we can work into the conversation now around what multiples of EBITDA are normally expected. Obviously that's effectively for the £3 million plus firms. I guess it depends on who's buying them, how rich they are.
Well, yes, I mean, say if we'd say 4 to 6, exceptionally 6 as a multiple of EBITDA, that would be about right. But remember, those deals, if you're talking to a consolidator, are different than if you're talking to an LLP. The consolidator offering will normally be debt-free, cash-free, which means they will keep the balance sheet, working capital, debtors, and work in progress, which usually lops 1 point off the EBITDA if you're just looking at the value of the goodwill. So if you're quoting 5 to 6, you'd normally be quoting 4 to 5 as the value of goodwill on a consolidator deal.
Very good. Thank you for answering that, Keith. Next slide.
Next one, Kevin.
There's dramatic pause.
Yes, poignant, I would say. So just deal with the consolidators and what's happening in the consolidator side for a couple of slides. The numbers of the opportunities and the pipelines, and we talked to a lot of the PE firms behind the management teams as well. So it gives us a bit of an insight into where those PE firms are going. Pipelines are perhaps not as strong as they might have thought they would be 2 years ago when they entered. There's enough deals in the pipeline though, and there are enough people who might consider selling out in the next few years to keep the PE firms interested. The values are still around 5 to 6 times EBITDA, but this is the point I suppose we've just answered. They are debt-free, cash-free. Exceptionally, for very large deals, you're looking at 7 to 8. Usually, if you're becoming a foundation business with a new PE house entering the market, one could possibly obtain that. But I think the interesting thing is in points 2 and 3 here, which wasn't really evident 3 or 6 months ago, February, when we last spoke to you, the audience. The PE houses are now talking about being early movers to exit, or some PE houses. And therefore, their move to divest and flip might be within a period of perhaps 6 months or 18 months. There are certainly 3 or 4 of them looking at the 18-month horizon, which means their overall investment will have been between 3.5 and 4.5 years, rather than the sort of 5 years that was always the mantra for PE investment. First movers, you might say, does this really mean that they feel it's a risky situation, they need to get out into the marketplace to find a buyer? Or is it that they just want to do a quicker turn on their investment and then move on to something else? So is it a risk factor or not? Haven't got an answer for that. But it's interesting that people are bringing that forward, and we'll show you the effects of that in some of the trends for consolidators and their targets in the next slide. But I think the other thing in point 3 is that we're now talking to the PE houses who are coming back and telling us that their anticipated exits will be around 10 to 12. And I think that's more realistic, because 6 months ago, people were talking about as high as 16 times exit. And it looks as though the only one that's really gone, as I understand it, is Assets, who sold off 50%, or HG Capital, which sold off 60% almost a year ago now to another PE house. And that is mooted, although not confirmed, that went for about 12 to 13 times. So with that as a sort of benchmark, the idea of 16 would seem to be a bit unrealistic for another PE house to come in. So we're looking at 10 to 12. And of course, if we're looking at 10 to 12, that means that the investments into practices such as yours, the cohort of the audience today, has a limited upside, because there has to be a turn for the PE firm and the management team. So the idea of doing most of the deals at 5 to 6 is most likely still realistic and relevant for these PE houses at the moment.
But I mean, are we basically getting to the point where the kind of rose-tinted glasses have come off, and the realization that consolidating accountancy firms is not a quick win. It's not an easy game to play.
Well, that's a very, very good point, actually, Kevin, because the other comments coming back from the PE houses themselves is, and you might all chuckle, is that they're finding the onboarding of their acquisitions a little more difficult than they originally thought would be the case. Having done a lot of work on integration and onboarding after mergers, it is a fact that is evident in the marketplace anyway. But the fact that they're coming out now and saying it's taking a little longer than they would have hoped is interesting. It's a comment really on the accounting profession and the relationships with clients, and I suppose an inherent I think everyone would agree, and I'm an accountant as well, so an inherent uncertainty or unacceptable change is not really courted, to be honest, and sudden change is never really entertained. So,
I mean, linking into that point, Keith, we did have a question sent in earlier pre-show, which it seems a good point to broach now. The person's asked, what opportunities are there for up and coming staff if the firm is sold and PE investment is taken on? Good, bad, indifferent?
well, I think we always put it fairly bluntly that if you sell to an LLP, which is still partner owned, without having sold any of its equity outside, you have a ready model which is very similar to your own, in that the partners can reach the highest levels, providing they perform and get the highest possible return in terms of their profit share. There is risks involved in it, of course, and there's money to be put on the table for capital investment. But generally speaking, that is one aspect of it. Whereas on the other side, we always spend a lot of time with our clients, if we're on a sell side assignment, talking to consolidators to make sure the younger partners are going in with their eyes wide open. There are changes, there are rationalizations with some of the consolidators. And of course, there is another PE house coming around the corner in 4 to 5 years' time who might change the strategy entirely, irrespective of what the management team are looking to do, the current management team are looking to do. In fact, the management team might even change if they take their equity off the table on the flip with the PE houses. So there's a lot of uncertainty for younger partners, which you don't get by going with an ALP, which has usually a very similar model and servicing model to your own. That's not to say that commercialization of the accounting profession is not a good thing and new models will not work. Of course they will. But it might change the relationship between the partner and the client, and it might also change the career prospects for some of the mid-level salaried equivalent to salaried partner or director level in terms of their future earning capabilities, possibilities within a consolidator environment.
Yeah. Thank you, Keith. Right, a couple of things. We're running at 35 minutes, so we've got to really wiggle through the next few slides. We've had a question in from Daniel. Daniel, I'm not ignoring it. I'm just going to broach that in the next few minutes or so. It is a consolidator-related one. So, Keith, yeah, we're running at 35 minutes. If you can, should we just move on? Next slide.
Yes, I think the next slide will feed in very nicely to what we've just said. We showed this slide last time to illustrate something slightly different. But it's interesting that the consolidator life cycle, which usually was going to be 5 years, reputedly, if it's reduced to 4 years, it does mean there are some fairly dramatic events in year 3. Remember, the consolidators are looking to increase their EBITDA. That's their mantra. They have to go out in 4 years rather than 5 years with an increased EBITDA, not necessarily wholly maximized, but certainly an improvement, because that's how they're going to get their return on their original investment. So the move to maximize EBITDA comes earlier. So it'll come in year 3, which is really represented by the blue line here. And certainly you've got some PE houses or management teams now who are going in the next 18 months, who are significantly increasing charge-out rates. They might not be getting the recoveries. They are rationalizing offices, and they are reducing the number of salaried partners. So that's all coming in year 3, so they can achieve the go-to-market EBITDA that they're looking for in year 4.
I mean, but increasing the level of transition, or condensing, I should say, that the amount of transition must increase the risk of it working.
Well, it does, but you see the increase in EBITDA, and it's only symbolic. This graph, of course, bar chart. But we have got one team who is actually looking to increase in that last year. They're looking to increase their EBITDA by 30%, which is a very significant figure and does lead to cost reductions in year 3, symbolically here, which are going to generate that EBITDA, which is what the PE house wants to get to. So yes, by shortening that time period of investment, it does make the rationalization consolidating
more
itself. That
intense.
rationalization will become fairly intense and disruptive, I think, for some of the relationships that we've spoken about previously with clients and also with staff.
Which must impact value, potential value, or potentially impact value.
Well, yes, yes, we've seen we've certainly seen a couple of people falling out of the consolidator models who cannot go back in because of their covenants, but are intent to come out and look to bring their clients with them after a period of a year or 18 months when they come out of their covenants. So it might not impact, funnily enough, on year 4 EBITDA, but I think the PE houses coming in to buy out the existing investors, and I think it will go to PE houses rather than IPO or anything like that, will be very cautious about fast rationalization transition in years 3 and 4 and the impact that's going to have on retention of clients in years 5 and 6 once they've made their investment. But the PE houses are quite used to this sort of thing, and they'll have clawbacks in place and earnouts to make sure they don't lose money.
We have literally just had a question asked in the context that has been set, who is gonna be the next set of owners, and you believe that there will still be PE interest.
Yes, I will. I think we can go on to the next slide, actually, Kevin, to move that forward.
Yeah,
this might answer the question. So
we're at nearly 40 minutes. So I'm just saying, let's just keep going for our dear audience.
We're well timed, Kevin. Relax, relax. I think we are anyway. So the profiling for the flip is certainly causing the exit of directors willingly from the PE house, particularly where there are multiple offices, and a consolidation of the clients into larger offices. So pressure in the model, which we've just alluded to, is all about scaling future growth, the level of organic growth and the time spent in that transitioning cost reduction. And are we really maximizing the organic growth from the current portfolio by selling additional services? All those are sort of conflicting pressures if you're going to shorten the consolidator investment period. So the third point on there maybe answers the question you're just posing. There's little appetite for IPOs in talking to the PE houses. Yes, they would like to do it, but I think the 2002 experiences with the known Vantages and Tenons and people like that still have the experience is still known in the marketplace. And indeed, the recent IPOs, perhaps in the legal sector, with Begbiz, Gateliz, Knights, and people like that, and there's one IPO that actually has not survived on the legal side, is cautious from the view of taking it to an IPO and the market in general. So we are left with PEs investing and buying out other PEs, larger PEs or bigger funded PEs, buying out existing PE consolidators. That's what we're looking at the moment.
I guess you can't rule out a fragmentation of one of them.
Well, in terms of the consolidator.
Yeah.
Well, I think there will be 1 or 2 deals from consolidator rationalizing into another consolidator. I mean, say, don't get me wrong, the market has not gone sour on the consolidators. They are quite happy with the progress they've made in general. And in fact, one of the PE funds did say that although they're going to get out in 18 months' time, they would consider going back into the accounting sector in, say, 2 years' time if the right opportunity came up, and they would revisit a roll-up with the right management team and the right foundation business. So there's still interest in it. They still see opportunities to build and sell and increase EBITDA from the experiences they've had over the last 2 years.
I mean, but and to answer the third question we'd had along the way from Daniel, I mean, the value should be driven by integration and synergies. If they're not doing that, then they're not creating the value, and by definition, that makes it easier for them for one of them, for a consolidated setup to be split, because it's not actually truly integrated.
Yeah, well, each consolidator has, they're almost unique models. Each one has a different model. But there is some good points in the marketplace that if you haven't integrated on brand, if you haven't integrated back office, if you haven't rationalized nationally and you've made 6 or 7 acquisitions, you're most likely going to get a lower value from another PE house than perhaps what they would be willing to pay for a totally integrated business with a common brand, common ethos, and a clear direction in what they're trying to do. There are some distinctly different models out there with the consolidators, and I'm not sure that my statement just now would be accepted by 3 or 4 consolidators who've certainly left branding a little loose. They certainly haven't done the rationalization, and in fact go to market on the basis that they might not be rationalizing. But of course, Baldwin's went to the market saying they wouldn't be rationalizing or changing any entity names. And of course, everyone in that group is now called assets, with the exception of Blick Rothenberg. So, I mean, it's an interesting point, Kevin, but I think there will be different PE multiples achieved by these consolidators going to the market because of the models they have followed and adopted.
Okay, we're nearly at the 45-minute mark.
Yes, can we move on to the last slide? Last slide, yes, please. So what we're asked quite frequently at the moment, and I think there's a question on your desk, I think, Kevin, as to how long will this money last? Will the PE houses withdraw from the marketplace? I think what we've said already is no, they won't. They will continue to grow where they see the opportunity, and where they see the opportunity of rationalizing and improving an EBITDA, which is, of course, what drives them effectively. What sort of models, business models that will come out of this on their flip, and indeed on the second flip, perhaps in 8 years' time, after the second PE house has come out, is, of course, a question of conjecture as to what the model will look like and the sort of clients that will be left. I mean, if we do a bit of work in Asia, we've been involved with a couple of roll-ups which are now 8 years old. They've gone through 2 PE houses. Asia market's a bit different, and it's not entirely accounting market, so we've got up to multiples of 17 times PE, maybe a bit more for certain larger businesses. And the new PE houses are looking very carefully at costs. So a new PE house just come in at 17 in Asia on a very big deal, are now looking at reducing costs significantly over the next 4 years to increase the EBITDA, and perhaps less emphasis on rolling up additional scale into the business. But I mean, they will roll up additional scale, but there's been a major emphasis on cutting costs, and in other words, changing the model.
So to kind of round things off, Keith, because we are over 45 minutes now, I just want to keep us wiggling on. So we were actually asked before the session started to almost give us the wrap up answer, which was kind of what is the crystal ball look like, in terms of if you peer into it, what does the market look like in 3 to 5 years time? What happens with the firms that are left out there? Do their values go up because there's not as many of them as there were before, or does the value go down because they're in a tougher market to operate within? Any thoughts?
Okay, yeah, you got a very good thing that we could have another half an hour on this. But I think simply answer the question, I suppose. There is nothing wrong with profit if you're an independent. And your value will be on your profitability, which again is EBITDA that the consolidators are looking at, but it's the profitability you can distribute, maybe under a custodian model to your independent partners. And that will always be good. And there are some very strong profitabilities out there, very good practices between 8 million and 40 million doing very well, and they will continue to do well. And the disruption caused as the consolidator model changes, in my view, will actually find some good quality clients falling out of the consolidation model. They will gain additional clients, but some good quality clients will fall out seeking that relationship between partner or direct partner relationship, which the consolidators can offer, but only perhaps in a reduced way. And also looking at pricing, I think some of the good quality clients will be moved on pricing, and the independents will be able to pick that up. Again, as the PE houses rationalize, they will drop good quality salaried partners who will come out and look at, or directors who will come out and will seek independent LLPs so they can maximize their profit shares after, of course, they've served off their covenants.
I guess a well-structured independent firm with a good focus, good people, and a clear understanding of what it is they want to happen if things change around them, but they can be in a good position.
Absolutely, and I think the models will run in parallel with the consolidator model, various consolidator models, and there'll also be the independent models. And I think they will recruit slightly different people, which I've mentioned before on previous presentations, and they will attract a certain quality of client as well. The problem for the independents is they will have to invest in IT, which will become more and more expensive to make sure they keep up with the marketplace.
Yeah. Okay, Keith, I'm going to wrap things up now. So thank you very much for that, Keith. Keith's details are on the screen, so obviously feel free to get in touch with him if you'd like to talk about your firm and its direction of travel. Otherwise, you can follow us on YouTube for more videos. Visit foulgerunderwood.com to find out more about us, read some of our articles about accountancy and the market. You can also find us on X at Foulger UK, and we're on LinkedIn. This video will be archived and available for you to access again. Just thank you very much for joining us. Great having loads of questions. Trying to put Keith to the sword, but he's always got a riposte and an answer for us. Keith, last word from you.
No, thanks very much for attending. It's interesting times, and we'll be running another one of these in sometime around October. So look forward to seeing you all then for an update.
Brilliant. Thanks, everyone.